Client sent me a podcast about a coming market crash. I listened to the whole thing, and here's exactly what I did next. By the end of this video, you'll know how to think about market volatility as someone approaching retirement without panicking and without pretending the risk isn't real. I'm Jerry Bulaclac, a financial advisor with Radiant Vest and a fiduciary, based in Tampa Bay and working with clients virtually nationwide. If you find this helpful, hit like and subscribe. I cover topics like this every week. The podcast was an episode of Diary of a CEO with Stephen Bartlett featuring investor Jeremy Grantham. If you haven't heard of him, he co-founded one of the world's largest institutional investment firms, and he has a track record of identifying major market risks before they materialize. So when a client sends that to me, I don't dismiss it. I listen, and I understand the impulse that came with it. Should I be doing something with my portfolio right now? Should I move to cash? That's a completely reasonable question, and it deserves a real answer. Quick reminder, before we go further, this video is for educational purposes only. It's not personalized financial advice. For guidance specific to your situation, please work with a qualified financial professional. Here's the thing about market timing. Even the best investors in the world can't do it reliably. Grantham himself has been raising concerns about U.S. market valuations for years. That doesn't mean he's wrong about the underlying risks. It means that knowing a risk exists and knowing exactly when it will materialize are two very different things. So the question I'm not trying to answer is a bear market coming? Nobody can answer that with certainty. The question I can answer is this: is your portfolio already built for the environment we're in? That's a question worth asking regardless of what any podcast says. When I listened to this podcast, I took the concern seriously. Elevated valuations, concentration in a small number of technology-related names, historically high price-to-earnings ratios, those are real things. They don't guarantee a correction, but they do suggest that a portfolio built entirely around the assumption that recent returns continue indefinitely may be carrying more risk than the person holding it realizes. At the same time, the prescription some people take from that analysis, move to cash, exit equities entirely, tends to create a different problem. You may avoid a short-term loss only to miss the recovery. For someone 10 years from retirement, that gap can be just as damaging as the downturn itself. I actually covered this concept in depth in a video called Asset Allocation in Your 50s. Are you taking the right risk? I'll link that above if you want the full breakdown. What I do instead of reacting to headlines is ask 3 questions. First, what's your actual time horizon? Someone who's 58 and retiring at 68 has a very different relationship with short-term volatility than someone who retires next year and needs to start drawing income immediately. Second, how much income does your portfolio need to generate right now? If you don't need to touch these assets for 5 years, a market downturn, even a significant one, looks very different than if you're withdrawing 4 or 5% annually starting this year. Third, what's your real risk tolerance, not your stated one? Most people say they're comfortable with volatility until they open up their account and see it down 20%. The answers to those 3 questions drive portfolio construction, not the latest podcast. Now, if you want to actually work through those questions in a real conversation, one of the first things I do with every new client is walk through a risk tolerance conversation together. Not a quiz you fill out on your own, but a real discussion about what the numbers actually mean for your situation. If you want to have that conversation with me, the link to schedule a complimentary consultation is in the description below. So here's what I actually did after listening to that podcast. I pulled up my client's current allocation and we walked through it together, not to react, but to make sure his portfolio was already built for an environment like this. And what I'm about to describe isn't a panic response. It's what a thoughtfully constructed retirement-focused portfolio may look like when it's designed with volatility in mind from the start. There are a few categories worth understanding. First, there are investments designed to absorb a defined portion of market losses in exchange for capped upside. Protection built in at the product level. Second, there's a liquidity layer, short-term cash equivalent positions that may generate yield with essentially limited market risk. In the current rate environment, those positions may be generating meaningful income while they wait. Third, there are equity-linked strategies that generate consistent income through options-based approaches with generally lower volatility than straight equity exposure, the kind of positions that may continue producing income even in a sideways or modestly declining market. Fourth, there's investment-grade bond exposure, locking in quality bond yields before any potential shift in the rate environment. Fifth, and this is one I find particularly interesting to explain, there are high yield bond strategies with a defined maturity date, meaning I know approximately when the principal comes back. It's not open ended credit risk, it has a scheduled endpoint. Sixth, there are floating rate credit strategies, positions where the yield adjusts with interest rates rather than getting hurt by them. And seventh, for some clients, there's an inflation protection layer because for someone in retirement for 30 years, inflation may be a bigger long-term risk than a short-term market correction. Now, I'm not suggesting every one of these belongs in every portfolio. What belongs in yours depends entirely on your time frame, risk, and financial goals. I want to be clear. This wasn't a reaction to a podcast. A well-constructed portfolio for someone approaching retirement may already include these elements regardless of what's happening in the news. I have clients and portfolios built along these lines. One couple in particular I've talked about on this channel. They retired at 62, they've been drawing income from the portfolio for years, and the portfolio has actually grown over that time. If you want to see that full story, I'll link that above. If this conversation made you wonder whether your own portfolio is positioned for what's ahead, I put together a free pre-retirement readiness checklist. It walks through the key areas to review before retirement, including your investment allocation. You can download it for free at the link in the description below. You don't need to predict the market to build a resilient retirement plan. What you need is a portfolio that was built with the real risks in mind, not just the risk of losing money in a correction, but also the risk of missing growth, running out of income, and getting hurt by inflation over time. You can't control what the market does. You can control whether your plan was built for it. If this video made you start thinking about whether you should be navigating these decisions alone, the next video was made for you. I walk through the honest answer to whether you actually need a financial advisor, including the situations where you genuinely don't. I'll see you there. Quick reminder, this video is for educational purposes only, not personalized financial advice. And I'm a fiduciary, so I'm legally required to put your interests first in everything I do.